distinguished guests, speakers, and participants, ladies and gentlemen, a very good morning, afternoon, and evening to all of you. On behalf of the General Council for Islamic Banks and Financial Institutions, I have the honor and pleasure of welcoming all of you today to this webinar on anti-money laundering and financial crime, recent regulatory developments and strategic considerations. Ladies and gentlemen, the increased regulatory scrutiny and sophistication of criminal activity have been pushing financial institutions to take increased efforts and put increased spending on AML practices. Despite of this, financial institutions still face large vulnerabilities and challenges today as money laundering typologies continue to evolve. And this is especially an increasing concern for smaller financial institutions who may lack the required resources to build strong compliance programs and meet regulatory requirements. And so financial institutions must constantly be aware of new AML risks and adopt a flexible approach when formulating their strategies in order to keep up with the evolving regulatory requirements and growing threats. And to do this, they must make use of new technologies that can result in cost and operational efficiency. And so we come together today in this webinar with a diverse panel of speakers to shed light on the recent developments in AML and the key strategic considerations for Islamic financial institutions in particular to navigate through its increased regulations and risks. So today we will be discussing several areas, including the evolving sophistication of money laundering activity, current challenges in AML practices, as well as the potential of technology for strengthened and efficient AML compliance. So, ladies and gentlemen, before we start, we would like to make a couple of announcements. If you have any questions throughout the webinar, please do not hesitate to write them in the Q&A section that appears below, and we will try our best to answer these questions as much as we can. The webinar will be recorded and posted on CIBAFI's social media platforms in the coming days, so please follow us on social media. And we will also appreciate your kind feedback on the organization of the webinar by filling out the evaluation form for the webinar. Please note that after leaving the Zoom platform, you will be directed to the evaluation link. So now, without further ado, I have the pleasure to call upon Dr. Abdelilah Belatik, Secretary General of CIBAFI, to deliver his welcoming remarks. Dr. Belatik, the crowd is yours.
Thank you, distinguished guests. Dear good morning, good afternoon, good evening to all of you, wherever you are. I'm very pleased to welcome you today to the CIBAFI webinar on anti-money laundering and financial crime, recent regulatory development and strategic considerations, which is the last webinar we will be conducting this year, but certainly not the end of the webinar series that we'll be continuing to organize in the next year and years. We will continue raising awareness on various emerging issues and trends that are of importance of the development to the Islamic financial services industry through these webinars and other activities and initiatives of CIBAFI. Before we begin, I would like to thank our distinguished speakers for taking the time to join us today and share their knowledge and experiences and expertise with us. Thank you very much. Ladies and gentlemen, as we are all aware, money laundering and more generally financial crime do not constitute a new phenomenon. They existed long time ago, and their urgency has been highlighted as an increasing concern since the past 5 decades and more. This led to the establishment of a number of related and international bodies and initiatives, such as the Financial Action Task Force by the G7 summit established in Paris back in 1989, aiming to devise international standards and promote national and international policies for combating money laundering and financial crime. Undeniably, though, the urgency has been increasing further in the past years, in particular with the COVID-19 pandemic, which we saw an acceleration of the digital economy and investment in technology brought new avenues for criminals to disguise their crime online. With cryptocurrencies, e-commerce, mobile banking, online banking, all these new trends were a good opportunity for criminals to conduct their financial crimes and their transactions of money laundering. It is estimated that the global money laundered is equal annually to around 2 to 5% of global GDP, equivalent to hundreds, 800 to over 2 trillion US dollar. The COVID-19 for sure, has been exacerbating money laundering activities, increasing the number of reported incidents, and as institutions took swift actions for digitalization, impacting in some instances customer due diligence procedures, allowing for vulnerabilities for criminals to exploit. In response, for sure, global authorities have been taking concerted efforts to strengthen anti-money laundering regulations and increase scrutiny and supervision. This has been resulting in multiple and continuous updates and examinations to existing regulations and the devising of new regulations in this regard. Recent updates to regulation comprise the inclusion of new types of activities and the purview of AML regulation, such as crypto assets, introducing new high-risk factors and emphasizing on beneficial ownership. Of course, the FATF, and we are very happy to have the executive director with us today, has been regularly updating the recommendations to ensure they are in line with evolving practices. These updates and revisions are continuing to emerge as money laundering and financial crime activity increase in sophistication and volume. In reality, in fact, CIBAFI will conduct regular surveys, and our surveys have shown that during the years we have seen increased concern over this, in particular on de-risking issues, which is a consequence of this. And Global Islamic Bankers Survey of just this year, 2022, Islamic banks ranked the implementation of AML-CFT related local and international regulations among their top concern for the next 1 to 3 years. This has been especially a prominent concern in the Middle East ex-GCC, North Africa, and West, Central, and South Asia regions. Concerns over de-risking and impact of political uncertainties were highlighted by some of the banks, especially smaller ones, while others highlighted AML-CFT compliance issues stemming from renewed emphasis on AML in their jurisdictions. To effectively navigate through the increased regulatory scrutiny and sophistication of financial crime, financial institutions will need to take several strategic steps to effectively build comprehensive, strong, and flexible AML programs. So we are very pleased and happy to have a number of experts from the field that will be sharing with us their expertise and experiences on how to tackle this at a strategic level and operational level as well. Before I conclude, just a few words on CIBAFI activities and initiatives. For the last few years, we are driven by various categories resulting from feedback we receive from our members. Sustainability issues, one of the big areas we are working on, and we have issued the last few months a sustainability guide, CIBAFI sustainability guide. We are working currently on a number of initiatives to promote that and to facilitate the implementation, together with working on climate change risks, and in particular areas related to carbon footprints of the portfolios of the Islamic banks. Other areas which is on the digital innovation, digital transformations, where we have our working group working on a guide for digital transformation, looking at various digitalization fields like the blockchain and AI and others, big data use in the banking sector, or Islamic banks in particular, with related capacity building initiatives that we are working on. Our Global Islamic Bankers Survey of 2022 was on women empowerment. The one on 2023, as many of you are aware because you have filled in this survey, is on talent management. I think these areas are of great importance, and as mentioned just earlier, we saw digitalization increasing, but with that, cybersecurity risk Anti-money laundering, financial crime risk has also been increasing. And this is one of the reasons why we are conducting this webinar, to shed light on some of the key challenges that Islamic banks or financial sector in general are having, and how to address them. With this, I would like to thank you in advance for your kind attention and your continuous support to CIBAFI activities, and particular thanks to all our speakers that will be sharing with us their insights and experience. Thank you.
Thank you, Dr. Belatik. Ladies and gentlemen, we would like now to welcome His Excellency, Mr. Suliman ALJABRIN, Executive Secretary at Middle East and North Africa, FATF, to deliver his opening speech. Your Excellency, please, the crowd is yours.
Thank you, Secretary General of the General Council for Islamic Banks and Financial Institutions. Distinguished guests, ladies and gentlemen. Good afternoon to you all. First of all, on behalf of the Middle East and North Africa Financial Action Task Force, I would like to thank the General Council for inviting us today and for holding this valuable event to increase awareness on recent regulatory developments in the field of fighting against money laundering and financial crime. Of course, as you know, this is the essence of what MENAFATF does and why we were established. As a way of background, MENAFATF was established in 2004 as an agreement by the countries in the Middle East and North Africa to enhance the implementation of the international standards, mainly the Financial Action Task Force recommendations and UN treaties and sanctions. We assess countries in the Middle East on their compliance and effectiveness of implementing those recommendations and standards. The most previous country we have assessed was Egypt, which was last year. And currently we're assessing a number of countries, including Qatar, Lebanon, Palestine, Algeria, Sudan, and Iraq. I'd like to also greet the high mission of the General Council in supporting Islamic financial services industry's growth by providing specific initiatives and activities that leverage the current opportunities while ensuring a strategic plan on the integration of sustainability and innovation, which is undoubtedly be ensured by protecting the integrity of the financial system through fulfilling its flagship and current role of detecting and monitoring suspicious transactions of money laundering and terrorist finance purposes. We are gathered today to discuss recent regulatory developments in the anti-money laundering field. But talking about the international standards and recent requirements must be preceded by first understanding the threat and analyzing the current digital context, which has given criminals new opportunities and sophistication to their money laundering activities. This should be assessed. Then we should assess the vulnerabilities by analyzing their causes and the challenges faced by both financial institutions and at the country level. Certainly, regulatory developments is a starting point that answers the question, which solution should we adopt? But the most fundamental and decisive question is how. And that is why definitely the challenge, and that is the level where the Financial Action Task Force methodology finds its full legitimacy by measuring effectiveness of implementing its standards and recommendations. I salute the wisdom of the webinar's program, which highlights this aspect and allows us the opportunity to discuss, first of all, the technology as a tool for combating the imminent threat and the flexibility of financial institutions' AML programs as a key to their robustness, which represents the essence of the risk-based approach on which the entire system of FATF standards is based upon. Today, we meet to point out what financial institutions must do, such as the obligation to comply with the new regulations in order to ensure high level of effectiveness in terms of preventive measures. In particular, the identification of beneficial owners as part of customer due diligence and the consideration of new amendments relating to new technologies in the case of virtual assets. In our fight against financial crime, we must recognize that the methods of money laundering differ. based on customer types, products, geography, means of distributions, and many other factors for money laundering scenarios which are more significant or can be more significant from one financial institution to another. And likewise, the measures to stop them may also differ from one institution to another. The risk-based approach is the cornerstone to effective implementation of the international standards. The standards should not be a rigid blanket application of requirements. The financial system has been built on risk management. Banks are expert at it, and it is how they make their money. Financial institutions should be focused on dealing with threats and risks, and yet still flexible enough so as not to affect innovation. Public-private partnership are an important tool and can play a crucial role. Without the right risk-based approach, the financial institutions cannot take the action when needed in a timely manner. The main regulatory developments carried out by the Financial Action Task Force, which aim to work and understand and set global responses to global and regional risks and operational challenges, and needs taking into account the regional perspective and specifications. Parts of the threats analysis process are risks relating to new technologies, which are on top of the list, as FATF has published a number of guidelines highlighting risks of those new technologies, products, and related services in creating new opportunities for criminals and terrorists to launder their proceeds or finance their illicit activities. The Financial Action Task Force continues to further clarify the application of the standards to new technologies, and continues to monitor virtual asset sector by adopting several guidances, last of which was published in June 2022, covering the travel rule implementation by the private sector and updating the decentralized financing platforms and NFTs emerging risks. It also includes guidance on digital IDs to assist in identification in the digital context. But of course, beneficial ownership is still a great challenge for everyone, whether at the country level or the financial institution level. In fact, customer due diligence measures are the first line of defense to money laundering, and the need to improve beneficial ownership due diligence and all member countries assess demonstrated a need for fundamental or significant major improvements in it. Yet, there's always room for improvement, and one main relevant action has been made to help mainly the countries, in addition to financial institutions, to overcome this challenge. So the ongoing work on recommendation 24, which deals with transparency of legal persons, and also recommendation 25 on the legal arrangements and their immediate outcome 5 of effectiveness, which states that the use of anonymous shell companies and complex financial structures for the purpose of illicit financing, as well as the exploitation of opaque legal persons and legal arrangements to conceal ownership and masking the laundered funds is a stark reality. Secretary General of the Council, allow me to express again my sincere thanks for this invitation and the support of the international cause of the integrity of the financial system. I cannot express enough my gratitude, having been able to share with you the latest regulatory developments in the AML field with our high-level consideration in this regard. And as a final word, there is much being done and much more to do. And as you work in financial institution compliance, you do make a difference. Thank you very much.
Thank you very much.
Thank you so much. Thank you.
Thank you very much, Your Excellency, for your welcoming remarks. Now, ladies and gentlemen, we will be starting the panel discussion of this webinar, which I have the pleasure to moderate. We're joined today with a number of inspirational speakers to discuss the evolving sophistication of money laundering activity. So let me introduce to you our speakers today. We have with us today Mr. Rinto Santoso, Director of AML-CFT Group at Financial Services Authority, Indonesia. Mr. Rinto has a long career in regulations and supervision in Indonesia. He has held various positions at the Capital Market Supervisory Agency and later at the Financial Services Authority in Indonesia, specializing in areas of examination and investigation, litigation and legal relations, licensing for a securities company. With us today as well is Ms. Sophie Good, Risk and Compliance Director at Group BDK, Senegal. Ms. Sophie possesses 20 plus years of experience in financial services industry. She has held several positions at renowned institutions across 4 continents, specializing in consultancy and advisory, financial risk management, and regulatory compliance. Across her career, Ms. Sophie has provided advice, support, and training in compliance and regulatory matters, and has helped in the development of AML programs for banks to comply with evolving regulations. With us today as well is Mr. Haider Ali Khan, MENA Financial Services Risk Competency Leader at Ernst & Young, Kingdom of Saudi Arabia. Mr. Haider is a seasoned professional in financial crime compliance and regulatory matters. Over the course of his career, he has provided advisory for central banks, capital market regulators, and other government entities on various regulatory matters, and managed several financial crime compliance transformation projects in the region. He has also provided advisory in the implementation of various technological solutions relating to sanctions screening and transaction monitoring. And last but not least, financial crime professional and money laundering reporting officer from Lebanon. Mr. Shawqi is an experienced professional with 20 plus years of banking experience, specializing in AML-CFT. He's also a lecturer and an experienced trainer, conducting several consultancy training workshops for building and strengthening capacities of financial intelligence units and reporting entities in countering illicit financial flows and mitigating financial crime risk across MENA, GCC, and East Africa regions. So welcome to all the distinguished speakers, and thank you for joining us today. So ladies and gentlemen, money laundering, as we know, is the process of disguising the origin of money generated by criminal activity to make it look as if it's coming from a legitimate source. And it's used by criminals to distance profits from their criminal activity and to enjoy the proceeds without drawing attention to their illegal acts. And over the years, money laundering and financial crime has been evolving, as has been alluded before, and is increasing in sophistication, with criminals continuously advancing their techniques to circumvent regulations and law enforcement, particularly through leveraging new technological advancements. And this has been driving multiple reforms and actions by regulators and financial authorities. And for financial institutions, this has been bringing an array of challenges, not only for compliance, but also for safeguarding their reputation and dealings with other financial intermediaries. So in today's panel session, we will be focusing primarily on the recent developments that have been occurring in money laundering and financial crime and its related regulations, as well as to how financial institutions can actually strategically respond to these increasing risks and activities. So let us kick off our discussion today with the first question that I want to direct to Mr. Shawqi. Mr. Shawqi, to set the scene for our discussion, can you please elaborate on how has the landscape of money laundering and financial crime been evolving in the past years? And to what extent do you think the digital economy plays a role in its acceleration?
Yeah, good morning, everyone. Good afternoon, depending where are you located. Happy to be here today among like-minded career professionals and colleagues within the anti-financial crime space. And thank you for the General Council and the Union of Arab Banks for having me. Basically, talking about a backdrop of an evolving industry maybe need like days to cover. Yet I would like to be as much as brief and focused to highlight the important themes or the breakthroughs that has happened lately within the anti-financial crime space. You know, technology has advanced, digitization has advanced, cryptos are the talk of the town nowadays. And in parallel, also criminals are exploiting all these technologies to launder the proceeds by using another kind of dirty technology. So, and here the statistics are not that promising or optimistic. For example, His Excellency has mentioned a couple of things that the FATF is doing at the forefront of combating illicit financing. And he mentioned the travel rule, which basically talks about identifying the players within a digital transaction, for example, the ordering and the beneficiary. And according to FATF, out of 100 jurisdictions, only 20 to 25 jurisdictions are applying the travel rule in terms of identifying the players within a digital transaction. So much work needs to be done on combating illicit proceeds coming from virtual asset providers. And we have seen an open season on virtual asset service providers in terms of the sanctions being levied and penalties by the OFAC and other regulators for not having the necessary compliance regime within their frameworks. Another thing is the hefty penalties that have been levied on financial institutions. Also, we have seen two, financial hubs and important jurisdiction within the region, because after all, we belong to this region. So the gray listing of the UAE and Turkey has sent clear messages and maybe have did kind of a wake-up call for all the jurisdiction within the region to beef up their AML-CFT measures. So everyone now is working more on harmonizing the regulatory environment on a private-public partnership, and this will definitely serve the anti-financial crime community and try to mitigate or preempt risk before it's happening. On the other side, we are faced with evolving challenges triggered by, unfortunately, the Ukrainian-Russian conflict, because this has led to a sophistication in sanctions. Sanctions are no longer easy to deal with. We know that since the annexation of Crimea, we have the sectoral sanction identification, which are very much fact-based. For example, if you have a downstream drilling within the oil sector, you need to apply sanctions. If you have another kind of transaction within the Russia or Crimean region, it will be permissible. And as a banker and head of I cannot tell you how painstaking is this for us to decide whether a transaction is permissible or prohibited from a practical point of view. Lately, also, we have another layer of challenge and complexity, and I'm sure many of you are aware of, is the price cap, which did not prohibit the export of seaborne Russian oil, but on the contrary, it's allowing the Russian oil to keep flowing on the market, however, with a price cap as a sanction threshold, so to speak. So now banks, financial institutions within the region, willing to buy Russian oil, need to make sure that the contracts are either done at the price cap or below the price cap. So this is another challenge. And maybe here technology cannot be leveraged too much, because you need some kind of manual checks and skilled teams within the compliance department and the trade finance unit. Also talking about technology, maybe AI or machine learning are still at their beginning in being or in making compliance people being reliant on them. Just to tell you a story and share it with the panelists and the audience, lately, I guess a week ago, the financial regulator has fined a credit for possible AML violation based on artificial intelligence solution that allowed the examiners to detect some deficiencies within Crédit Agricole. Yet the critics or the AML community regarded this as, or they are being somewhat skeptical about, in the sense that maybe the examiner or the regulator does not know how AI is functioning, and Crédit Agricole may not be convinced about these penalties. So relying on artificial intelligence and machine learning within RegTech or SupTech is still also in a mature stage. Also, we are in challenges with identification of ultimate beneficial ownership and the scattered rules among the United States and the EU, and how financial institutions within the region must understand the legislation when dealing with their European correspondent or with their US correspondent, because the control prong is a bit different between the EU system and the US system, as well as the ownership. I don't know if I have gone beyond my time. I will stop here. Maybe later I will catch up with my ideas after my fellow panelists do their intervention.
Thank you very much, Mr. Shawqi. And you've touched upon a number of important developments when it comes to money laundering and many of the aspects that we'll be discussing as well further in our discussion. But I want to now focus on regulations in specific, because with the acceleration of money laundering activity, regulators have not been standing still, right? The regulatory landscape has never been more active, with multiple reforms taking place to strengthen anti-money laundering action. And a very recent example is, for example, the agreement that we saw on a new strengthened anti-money laundering rulebook in the European Union. So to know more about these developments, I want to direct the second question to Mr. Haider. Mr. Haider, can you share with us the recent steps and initiatives that regulators and international bodies have been taking globally to combat money laundering and financial crime?
Thank you. Thank you very much, May. Assalamu alaikum, everyone. Good morning, good afternoon, and good evening, everyone. Stay safe and healthy wherever you are. Very pleased to be here with the and very warm welcome to His Excellency as well as the General Secretary. Thank you for having me today. So May, basically, just building upon what has been said already, there definitely regulators and standard setting bodies have been scrambling to keep up the pace with the developments in the region as well as globally from a perspective of money laundering and how the bad actors have been taking advantage of any loopholes in the financial systems or from a perspective of controls in the financial institutions. So, but the one thing that is quite encouraging is that the will and the understanding is there among regulators, among governments, and across the financial services industry to take the right actions and measures to control and counter the effects of these illegal activities. From perspective of FATF, things have already been discussed, but I think some things that I would like to highlight is obviously the much talked about enhancements and changes to the recommendations 24 and 25 from a beneficial ownership perspective, which has now, we are seeing the downstream effects of those recommendations. So for example, in US, there have been changes and it is expected the beneficial ownership registry will be created and other aspects are being clarified and which was quite long awaited. Similarly, within the European Union as well as the United Kingdom, the beneficial ownership databases and requirements as to further enhancing the controls and due diligence from a perspective of legal entities and their ownership is being instituted into the processes. I think more recently, from a local perspective as well, we have seen UAE, as well as Saudi Arabia, just making those right changes and enhancements to their regulations from a different perspective of ownership of trusts or OCAF or other areas as well. The other thing I would like to talk about is I would say, the enhancement and encouragement from a FATF downstream to all the other standard setting bodies as well as regulators is the encouragement of financial institutions and the industry to use new technologies and tools from a perspective of countering the effects of digital advancement. I think we will touch upon this subject at a later stage, but that is something, again, which is quite pertinent and I would like to highlight. I think virtual asset regulations is another thing that we have seen a lot of work being done across the industry. I think from a perspective of local regulators, we have seen almost all the major players in the region, in the GCC region, have issued their virtual asset regulations. We have seen Saudi Arabia coming up with the PSP regulations, as well as the personal data protection law, and more recently, the anti-fraud law, which we have seen most of my clients as well as their local banks working on those regulations and trying to build up their processes, their systems and technology so as to counter and the effects of financial crime in that area. we have seen certain, I would say, regulatory bodies being set up. For example, one example is the Virtual Asset Regulatory Authority in UAE, which has come up with guidance and the requirements around licensing of all the virtual asset service providers in their country. So these are few of the other regulatory developments that we have seen in the region. I think another very important thing to highlight here is the changes to whistleblowing regulations across the globe and the encouragement in terms of, for example, in the US, we have seen the regulators have enhanced the threshold or I would say the reward money from a flat 130,000 US dollars to almost 30% of collection by the regulatory authorities. Very recently, I think hot off the press is the whistleblowing guidance issued by Abu Dhabi Global Markets and other regional regulators as well. So I think lots is being done. And as said earlier, a lot has to be done further in terms of regulatory developments and its implementation across the industry. I'll just pause here now.
Thank you very much, Mr. Haider, for this detailed response and for these developments that you have mentioned and highlighted. And actually, yes, we can see regulators taking continuous and concerted efforts for strengthening the regulations and advancing their fight against financial crime and money laundering. So we want to take now a specific example to understand more about these regulatory developments and how regulators have been responding. So Indonesia has been strengthening its anti-money laundering regulations and action over the past years. And back in 2015, they have been removed from the FATF blacklist, and they were congratulated actually for the significant progress that has been made. So Mr. Rinto, from your experience, the Indonesian experience, can you share with us when it comes to anti-money laundering and supervision, what has been happening in your country and what recent steps have you been taking?
Yeah, Indonesia, especially Indonesia, really support the development and acceleration of digital economy, including through RegTech and StopTech. Currently, in the finance sector, there are several new industries that are reporting parties and are required to implement the AML-CFT program, namely fintech peer-to-peer lending, fintech securities crowdfunding, and digital financial innovation. In addition, in the discussion between government and parliament, it is planned that the Indonesia FSA or OJK will have, so that it will also include, but not yet in the.
Mr. Rinto, I think there's a problem with your connection. So can you hear it?
At this time, all country will certainly therefore the entire recommendation of the FATF, so that okay. Is it position?
Yeah, there is some problem with the audio. So I think we can come back to this if you can check your audio, and we can move to another question and then come back to it. Or you can check if it's working. So, okay. So I think we will move to another question, then we come back to Mr. Rinto. So with the increased regulations that we're seeing and the increased regulatory scrutiny, what we have been seeing and has been mentioned before is a series of fines that are being given to financial institutions for not adequately actually responding to AML or not having the right AML controls. And this leads me to this next question to Mr. Shawqi. With these continuous failures that we are seeing alongside, of course, the increased regulatory scrutiny, to what extent do you think financial institutions today are well equipped when it comes to devising strategies and systems for money laundering detection and prevention?
Actually, before that, I would like just to echo some of the points that Mr. Haider has alluded to. Among the things we are seeing in the region, he referred to the ATGM whistleblowing policy, which underscores the importance of transparency and not retaliating about those who may disclose something in good faith about financial crime. So incentivizing the community, the people, the stakeholders to always disclose what may help financial institution in risk mitigation. Another thing that I did not mention from the outset, which is a technological migration for financial institution, of course, across the globe and within the region, is the swift migration from the message type or MT to MX, which in terms of financial crime have an impact because the MX stack, which I guess use an XML format, I'm not a tech savvy or tech freak, but yet I know that the MX may contain huge data coming or transferring into an MT, despite having a converter to do this. This may add some kind of risk for a financial crime prevention system in terms of sanction screening. So this is also worth of mentioning here. Another thing is the AMLA Act, which has been rolled out by US authorities. And definitely this has, in a way or another, led to a shift or a paradigm shift in how we deal with US correspondent, because May, correspondent nowadays are the financial lifelines of banks within the region, and the de-risking wave has not yet subsided. We are still living the implications of de-risking. So the AMLA, the provisions of the AMLA mainly are four. It's the whistleblowing, it's the Corporate Transparency Act, which will have a cascading impact on UBO identification, but with US nexus for US companies. Another thing that the AMLA is, and this is most important, is the subpoena authority, which allows US institutions to have like unfettered access to non-US financial banks within the region if these banks may to have aberrant transaction or some anomalies in their trade finance or cross-border activity. Another thing within AMLA is, of course, the extra territorial impact of this regulation on financial institution within the region. Now, back to your question on whether or how well guys in the MENA GCC are well prepared to face these challenges and mitigate the risk. As far as I know, that no bank is weak in terms of compliance. Most banks are allocating necessary budgets or necessary headcount for within their compliance teams or anti-fraud teams or AML teams. However, as a practitioner, I have come to realize a couple of things within financial institutions, that sometimes we are still focused or living in our own bubble and focusing just on classic money laundering risk, which sometimes I call the fixed mental model. You know that the original crimes or the predicate offenses leading to a financial crime or an anti-money laundering crime are so widespread. There are 21 predicate offenses, including, let's say, tax evasion, wildlife trafficking, anti-bribery and corruption, counterfeit goods. So sometimes banks fail to focus on these areas because you can still have a transaction that underlies, for example, human trafficking or human smuggling proceeds. So are our systems able to detect these transactions? Because once you detect, you have to analyze, and after you have suspicion, you have to report to the FIU through the STR process. So are we able to calibrate our sanction tool to train our staff to detect these subtle alerts? Sometimes they are not that clear within the transaction. So are we able to identify dual-use goods through, for example, a trade finance transaction? So here, I think we need to have more serious work, either on training or system calibration or having advanced software and skills to analyze also legal entity and complex ownership structures. And this is what the gentlemen have been emphasizing on, which are basically recommendation 24 for legal entity and 25 for legal arrangement like trust, where usually and sanction evaders hide through creating complex layers of ownership. So I guess for trade finance, we need to be more vigilant. This banking product is or contains so much structured data where sometimes technology fail in detecting, for example, the port of offloading, and sometimes we have changes throughout the life cycle of the letter of credit, whether in the goods or the manufacturer or the port of loading or the port of discharge or the shipping routes. And here there are a lot of technical issues that we need to know about, from the vessel route to how to search for a vessel regarding sanctions. Is it by name? Is it by the IMO, which is the International Maritime Organization number, which is similar to the plate number of the car, which does not change. So sanction evaders cannot change the IMO, but they can change the name. So they rename the vessel to evade sanctions. Here, I guess the risk lies, and robust work needs to be done, and collaboration, also a commitment from a senior management, awareness and risk mitigation, and fostering a think risk culture to maybe mitigate these emerging risks within the banking industry.
Thank you. And thank you for all these important points and the challenges that you have mentioned, including the complex layers, the de-risking. And I want to bring Ms. Sophie now in the discussion. Sophie, in line with the points that Mr. Shouqi has mentioned, and you are the Risk and Compliance Director at Group BBK in Senegal, and we know that Senegal is on the grey list of the FATF, or in other words, it's among the jurisdictions that are put under increased monitoring. So from your particular experience, what challenges do you see financial institutions facing in dealing with money laundering concerns, specifically in these regions?
Thank you. Can you hear me fine? Yes. I would like to thank you first for giving me this honor to speak in the General Secretary. So, as you said, I think I can give you here my perspective and my experience from West Africa, and especially in a grey list, FATF grey list country. I think for us here in West Africa, there are three main challenges that I can see facing and dealing with the fight against money laundering and financial crime in general. The first one being really the reality of Africa, and I'm going to expand to that. And the second one is really internally as well, within our organization, and a little bit about technology in that sense. And then the third aspect would be the third parties, and we talked about the correspondent bank, de-risking, and our regulators as well. So when I was talking about my first point, the reality of Africa, Africa is really filling the gap in terms of governance, but it's a major step. From what I see on the ground, there's really increasing awareness and increasing enforcement of anti-money laundering standards and regulations. And I can quote for that the government of Senegal, who has put in place a beneficial owner register, but this is only for extracting activities. Of course, we would like to see more than that. Of course, we would like to see more than that and more effort in that sense, but it's already a big step. I think another thing would probably be the education and the culture in West Africa, because it's a very cash-intensive business. And for us, financial institutions, this is obviously a big challenge. This is understandable because there's a lot of non-banking, there's a lot of informal economy. 80% of the country is informal. So the non-banked population is obviously using the means that they have. And today the means is really cash. There are more and more wallets, electronic money and wallets that we see developing, but this is obviously not enough, and not something that you can use as well for other major, bigger transactions. And this aspect is very crucial because financial inclusion is a major thing and a major challenge for Africa. So we have to balance, financial institutions in the region really have to balance between financial inclusion and the strict search of money laundering that we see. I guess another aspect as well in the reality of Africa is that nowadays more and more, and unfortunately, West Africa is used as a road to transit drug from Latin America to Europe, and this is also obviously a major concern for us. There we see more and more seizing of drugs. We see more and more officials being corrupt because of this. And the last thing obviously is terrorism in the Sahel region, which is as well obviously a major concern. As to my second point, I wanted to develop a little bit other challenge that we're facing internally as financial institutions. We obviously have to train the workforce, and this is This has always been the case, but this constant monitoring and having the right reaction from our workforce is really something that is also difficult from a cultural perspective. Here we have the PEP that have a major role in the society, and this is really something, a big challenge for us. Obviously, the technology as well. Technology, we use more and more technology, but technology is not always accurate, and you always need most of the time to go deeper in the analysis, which would require human intervention, or you need to have obviously very good and sorted data quality in the system, which is unfortunately not always the case. Technology nowadays enables us to have this distance with the clients. We don't do any more face-to-face. We don't visit clients anymore, which is a great thing in itself, but it's obviously increasing challenges for us. And my third and last part with regard to challenges of financial institution in the region relates to third party and regulators. We talked about that, but de-risking is a major challenge for us. Definitely, we have seen a lot of major financial institutions withdraw from Africa, which is for us. We have, excluding the weakest and not giving them this opportunity to develop is really a major challenge for us. We have increased sanction. We've talked about that, and Mr. Shwoki talked about it. We had in West Africa as well our own local sanctions in Mali because there was a coup. So this was also very, very tricky for us to set up and to comply with. Also, I would like to say that in terms of third party, it's not only the correspondent, it's also the fintech industries is a good thing as well. But if you partner with the fintech, they might have different interests as well. We've seen N26 that had a lot of compliance issue. And for us as well, this is as financial institution, it's again, another big challenge to have this balance, applying strict standards and also developing financial inclusion, financial access. So this is in broad terms what I wanted to give as a perspective from West Africa.
Thank you, Ms. Sophie, and thank you for highlighting all these challenges. I think we have Mr. Rinto again with us. So, Mr. Rinto, is the audio well?
Yeah. First of all, please forgive me because there is a connecting problem in here. And second of all, is it possible I deliver my presentation that I will?
Yes, I think there is a
And
problem.
I will
Yes.
turn off.
So I think there is a bit of a problem.
Okay. Good afternoon. Do you hear my voice? May
Yes,
RC?
yes, Mr.
Do you hear my
Rinto.
voice? May RC?
Yes, Mr.
Okay.
Rinto.
Okay.
Unfortunately, still we have a problem. Unfortunately, there is still a problem. So I think we can move to other points and then.
If you allow me, May, to just do a quick comment of what Sophie has just said.
Please.
And sorry for the colleague from Indonesia, I guess, for having trouble in the connection. We missed him. Basically, I totally understand the risk that Sophie has highlighted. And I have done a couple of projects within Ethiopia, Addis Ababa, and really the challenges are very big there. And also some kind of regulation put so much onus on financial institutions. So if you take, for example, the Magnitsky Act, which has been hitting hardly the politicians and the political regimes within Africa, especially when you have exploitation of the natural resources. And we know how rich is Africa in terms of natural resources and in terms of the wildlife they have there. So this has really led many regulators to roll out sanctions either for illicit financing or for human rights abuses and corruption. So this is one thing mentioned. Also, many jurisdictions now are imitating the US by designing their own Magnitsky-like sanctions. So we have many jurisdictions now also targeting corruption. So you may tell me, okay, corruption within the government, what banks have to do with all of this? No, banks can be the safe haven for these politicians or their associates. Also, if you have a customer entering the public sector through tenders and delivering or implementing projects for the government by bribing the minister or some kind of government agencies to win a bid for a big project or infrastructure. So these customers will be transferring the risk to the bank, and the bank may be again under the spotlight and fall within the cracks of sanction and may get the penalty. So this is a real risk, whether in Africa or in other third world countries, not to mention only Africa. Another thing is that just a couple of days ago, the compliance community was also taken by surprise, but this is a positive thing. The UN Security Council Resolution 2664, I guess it has an unanimous vote within the 14 members of the United Nations Security Council, with India being the exception, for voting for lifting sanctions on assets that may be used for humanitarian issues. So this is again another challenge for jurisdiction within or jurisdiction that are targeted by UN sanctions. They are now free or can lift the blocking on certain assets if these assets are made for humanitarian or assistance or reliefs for vulnerable people within their communities. So this is also another challenge for banks in knowing when and how to lift the asset freeze. And again, back to the due diligence, making the necessary enhanced due diligence to know that at the end of the day, the lifting or freeing the asset is not going to the criminal or to the PEP, but to the needy people who are in dire need of medical or any kind of humanitarian assistance.
Yes, thank you, Mr. Shawqi. Mr. Haider, you want to add something?
Yeah, thank you, May. Actually, thank you, Mr. Shawqi and Ms. Sophie, for your very important and pertinent input. And I just wanted to add to Mr. Shawqi's comment on the lifting of the United Security Council of the sanctions on vulnerable or areas where you have, I would say, population that is vulnerable and you have economic sanctions. I think whilst this is a great initiative by the United Nations Security Council, but it definitely puts a lot of onus on the financial institutions in those areas and in terms of having the right due diligence, which he has mentioned, and then the downstream risk assessment of the customers, as well as these sanction screening capabilities, and more so the transaction monitoring as well. I think these are few areas where the banks have to think about how they have watertight technological solutions available, whether it be your artificial intelligence that is much hyped about it these days, your other deep learning and machine learning capabilities, and from whether you deploy those through your risk assessment exercises, all your other areas, life cycle of a transaction within the financial institution. But I think financial institutions need to definitely think about how they have the right controls in place, so that on the one side where they are actually enabling this for the needy people, but on the other hand, they do not fall victim to any illicit or I would say money laundering activities and are sanctioned or penalized at a later date.
Thank you, Mr. Haider, and thank you, Mr. Shawqi and Sophie, for really highlighting all these challenges. And I want to continue with the point that Mr. Haider, you have mentioned now, because we've looked at a lot of challenges on when it comes to how financial institutions are dealing with money laundering and the challenges they're facing. And now let's focus on solutions. What can financial institutions really do to fight against money laundering and ensure actually compliance with the increased regulations that they are having? And at that point on technology, specifically, I want to direct this question to you, Mr. Haider. How can financial institutions actually harness technology and the emerging RegTech for actually strengthening AML? And how exactly?
So thank you, May. Basically, yes, I think definitely the regulatory technology or RegTech is something that can bring in a lot of capabilities and capacity to the financial institutions if used in the right manner. I think this can help them increase agility in terms of looking at different data sets and coupling and decoupling data sets, and then inferring the right information out of those and using it for various analysis, whether it be your customer due diligence or understanding transactional behaviors, and then in terms of your filing of suspicious activity reports and other elements. It can also help you integrate your legacy systems with other fintech or innovative solutions and provide greater services to your customers in enhancing, I would say, inclusion, financial inclusion as well. On the other hand, it can also help you in terms of having the right speed in terms of issuing different reports for your regulators and other stakeholders within the organization as well, and have the right decision-making capabilities, whether from a perspective of sanction screening and deciding is this a customer which may be sanctioned or not, or a beneficiary which may be not the right beneficiary that you should be interacting with, and from a legal entity's perspective as well. I have touched upon different nature of technologies, but I think these technologies do include use of robotic process automations for some repetitive tasks where a lot of human intervention is not required, whether it be from a perspective of first level screening of your alerts, and then at a later stage when you have requirements for greater human intervention and judgment, you bring in your resources, which are always scarce and not available very freely. I think another thing what we are seeing is different financial institutions across the globe are now deploying RegTech solutions, whether it from a compliance monitoring perspective in terms of having the right capability to have the control over your compliance and regulatory universe, then having the right capability in terms of mapping your risk or obligatory requirements to your controls and identifying any gaps and ensuring that the compliance monitoring within the institution is at the right level. Coming to the more AML focused areas, I think all these technologies, whether it be artificial intelligence in terms of cognitive or non-cognitive capabilities, and then going deep into your machine learning capabilities in terms of looking into data and list of, I would say, your transactions and inferring the information out of it for your behavioral scans, and then being a bit ahead in terms of how the financial institution or a bank reacts to a probable bad actor. I think these are a few examples that we need to be thinking about, the financial institutions to be thinking about, and looking into how they can implement these technologies to support regulatory monitoring, to support, I would say, risk assessments, to support customer due diligence, I would say sanction screening and transaction monitoring. And these are few areas where all these technologies can come in very handy. The last thing I would like to add is the technological or subtech or easy technologies that our regulators are now considering, and I would say in various jurisdictions they are either implementing those or are in the advanced stages of testing those capabilities, whether from a perspective of financial intelligence units and having the right capability to sniff or work through large data sets, and having the capability of integrating and communicating with other law enforcement agencies so that they can take the right corrective measures at the right pace. I think I'll just stop here for the time being.
Thank you, Mr. Haider, for highlighting all these areas. And I mean, yes, technology has a lot of potential and for anti-money laundering and regulatory compliance. But of course, technology is complementing. On its own, it's not enough. We need a formulated anti-money laundering program, which in many cases is a regulatory requirement. So, Ms. Sophie, I want to direct this next question to you. How important do you think is a comprehensive anti-money laundering program for financial institutions? And how exactly can they ensure the effectiveness of their programs when formulated? given all the challenges that we have actually highlighted earlier in our discussion?
I'm sorry, I had a audio issue. Can you restate?
Yes, sure. So I was asking you, actually, we said that technology is really complementing to an anti-money laundering program. We should have an anti-money laundering program that is flexible and so on. So I wanted to ask you, how can financial institutions ensure the effectiveness of their programs when devising them, given all the challenges that we've highlighted earlier in our discussion?
Right. Yeah. Well, especially with regards to technology, this is, I think Mr. Haider touched upon that a little bit earlier. What the major challenge for us, I think, is the data, the quality of the data. Integrating a RegTech technology into our framework, we need to make sure we have the right data. And then the analysis of this data, the mass of the data can be run through the technology, and then the refined analysis can be done with the people. The data for me is the most important thing in the technology. Then more broadly, of course, having an efficient AML compliance and anti-money laundering and financial crime and fighting terrorism framework is obviously to have the right standards that are probably adapted to your environment. Again, I was talking about the reality of Africa, and I think there is a question as well from one of our participants about, for example, money transfer without movement. This is a reality, and I think nowadays FATF and banks need to recognize that and approach that in, like tackle the issue with what the reality is. And that's what we try to do here in Africa. We're going step by step, and we're educating our clients about how to change this, how to accept international standards, why is this so important, and why are the consequences so important? Because obviously when you stay in the microcosm of yourself, you don't see that. You don't see the biggest image and vision of fighting against the money laundering. But we have to play this role towards our clients and also obviously for the country. And we have to apply these in our requirements. So again, we set standards that are international standards, even though we are in an emerging country. And this is again something that we need to implement throughout our policies and procedures. And this is what our policies and procedure needs to be adapted to our clients and to their reality in terms of how they use the financial system and our financial institution.
Thank you, Ms. Sophie. Do any of our other panelists want to add on this point?
Yeah, if you allow me, I would like to add a couple of comments regarding the technology side, please.
Yes, please.
Basically, still, despite artificial intelligence or machine learning are still under examination and in a nascent stage, have much room to harness technology to mitigate emerging risks. Just for example, Mr. Haider mentioned, for example, RPAs. I would like to add, for example, OCR, which is the optical character recognition. This is kind of good technology, for example, within the trade finance business to mitigate what we call TBML or trade-based money laundering. It has the capability of alerting or detecting keywords that may overlap with a sanction list, a sanctioned jurisdiction, sometimes a certain commodity that falls under dual-use goods, which means that the good or the commodity may be used for civil purposes as well as military purposes. So this technology can go through unstructured data, through pro forma invoices, through the bill of ladings, which the trade finance industry uses a lot. It's a document-intensive process. And according to ICC, just to sound a bit anecdotal, there is around 4 billion papers circulating at any time within the trade finance business. So to know where the sanction risk lies, because you cannot screen this flood or the big data on a sanction screening tool, you need some kind of technology, and OCR can do this work and try to look for risky parameters or key risk indicators within the trade finance document life cycle. So also, given the advanced report and statistics, for example, provided by the cross-border SWIFT systems, you can also know the jurisdictions that you are sending your outbound payments to, so you know your concentration risk. Are these jurisdictions falling under the FATF gray listing or the FATF blacklisting? Are you sending something by mistake to a third party in a sanctioned territory? So these kind of reports do give you an acceptable heat map telling you where you stand vis-a-vis the money laundering or terrorism financing risk that you are being exposed to.
Thank you, Mr. Shawqi. And I mean, we have highlighted very important points when it comes to how financial institutions can actually address money laundering and how they can use technology and what possible challenges could arise with this. And I want to end this discussion before we move to the Q&A with a very important point, perhaps in our discussion today, and a key point, which is on Islamic financial institutions in particular. We know that Islamic banks and financial institutions, they do have unique risks and contractual relationships with their customers in comparison to conventional counterparts. And that is due to the different instruments and contracts that they employ. So given that, do you think that there should be any specific considerations for Islamic banks and financial institutions when they are devising their anti-money laundering systems and programs? So okay, we can start with Mr. Shawqi and then we can move to all other panelists.
Okay, I was just want to ask if you are addressing this to me. You know, frankly, I haven't worked within an Islamic financial institution, but I guess the risks are too generic. We are all facing the same, whether we are in the legacy banking system or Islamic financing. I don't know what kind of key takeaway or advice we may say, but again, I would like to be pragmatic because I've been into the payments area, the trade finance. I have authorized SWIFT payments. I have detected discrepancies in documents, been into investigation with correspondents. So from all of this blend of experience, I would say the bank should understand its risk, its complexity of the product, its geographic footprint, and the only scientific tool we are left with is the risk-based approach, which may not be that ideal. It always has its flaws, its downside, but we try to perfect it as we go. So this is the only way is to approach risk within a scientific approach by allocating the necessary risk for the product, the customer, and the geography. And maybe it's good also to have dual or double risk assessment in the sense that you need to assess your money laundering risk in a certain methodology or matrix, and you have to do your sanction risk matrix in parallel. Because when you use, for example, sanction risk for a certain country, it may be high, but when you assess the money laundering risk for the same country, it may be low. So the two risks are too distinct, and we should not fall in the trap of if we have a high money laundering risk, it means we have a high sanction risk. No, it's different. What may be high in sanction may be low in money laundering and vice versa. Also, the organization should not operate in silos. There should be a shared responsibility. Reporting from the compliance should be sent to the front line to acquaint them with the risk at hand, with the SDR processes, with the rejection of funds, the refusal of customer. All this data must be on the desk of senior management and the frontline teams. Also, this dual brain syndrome, for example, whereby the compliance team reject the business for certain risk and the business people want to grab the business for bonuses and the profits. This is also is lethal and fatal for the organization. There should be, or both should reach a compromise or an understanding of the risk appetite and try to strike the right balance between the two. So the both will be on the same page. Again, maybe also building or capitalizing on technology, knowing your customer is vital, knowing the other side of the transaction is vital. For example, who is dealing with your customer, the supply chains. And this is maybe better achieved through a new technology, which we are still testing maybe, and the industry is still experimenting, which is the PKYC or perpetual KYC, making the Know Your Customer a live document, which is updated based on certain behaviors and transaction done by the client. So, you know, in a very real-time way, what is his business profile as we speak, instead of remediating, rectifying, and updating it in a snapshot from time to time.
Yeah, thank you very much, Mr. Shokli. Mr. Haider, if you want to add to this.
Yeah, thank you, May. Thank you, Mr. Shoki. I think I'll just add, I have to admit, Mr. Shoki has basically given a very comprehensive response and covered almost everything that comes to mind. But a couple of things that I would like to add. One is definitely the use of technology in terms of contract negotiation or contract drafting and review from an Islamic bank's perspective, irrespective of what contract or product, I would say product or service is being offered. And I think, again, as mentioned, OCR technology or other technologies from the perspective of just ensuring that you do not have any clauses or anything which increases or exposes the financial institution to greater risk of sanctions or greater risk of being exploited from different angles. I think that is one thing. The other is greater collaboration with the industry stakeholders. I think whilst definitely within the institution, the knowledge sharing and the I would say review of documentation by different stakeholders is of paramount importance and cannot be stressed enough. But I think the sharing of information with your peers, your stakeholders, with having the due regard to the personal and data protection and privacy laws. But I think sharing your experiences in terms of how you have dealt with a certain situation can just enhance the understanding and controls at the industry level. And then lastly, with sharing the data and information with your stakeholders, such as regulators as well, is of a lot of importance as well.
Thank you, Mr. Shokli. Mr. Haider.
May
Yes.
I would like to add from Indonesian perspective. Is
Yes,
it okay?
please. Yes. Okay.
Without comment. According to technology development, along with technology development in the financial service sector, OJK or Indonesia Financial Service Authority as a regulator has fully supported the implementation of regulatory technology or RegTech from the industry side and supervisory technology or subtech from the supervisory side, both in terms of regulation and implementation. In order to that, it reminds that an inability to identify, assess, and mitigate the risk of MENAFATF can detain the implementation on AML-CFT program. Therefore, the use of new technology can provide value added and become one of the solutions. Moreover, in order of supporting RegTech, Indonesia FSA or OJK, Financial Service Authority or OJK, encourage FIs to get access to digital ID, including biometric data needed in the verification process through approval and recommendation from the FI supervisors and Department of Population and Civil Registration, or we call Dukcapil, to utilize identity number, population data sources, and electronic identity card. Based on our regulation, there is verification through face-to-face meeting and face-to-face verification through electronic means such as video banking, which is online, real-time, and reliable. There is already a regulatory framework that allows the non-face-to-face verification process through data as data. MENA-CFT OJK regulation also verification is conducted through electronic process and facilitate entity owned by the FIs and or prospective customer should utilize resident data that meets two authentication number. Namely, what you have is the identity document owned by the prospective customer, namely the electronic identity card, and what you are, namely the data among others in the form of fingerprint belong to prospective customer. We also have digital banking OJK regulation. The verification process carried out by the bank can be done through face-to-face using software owned by the bank, with hardware owned by the bank, or hardware owned by the customer or prospective customer. Non-face-to-face using software owned by the bank, with hardware owned by the bank or hardware owned by the customer or prospective customer. Indonesia FSA also since 2016 have been concerned about technology development on financial technology, and it made us create information technology risk management regulation, or we call ITRM. Related to ITRM have been applied in the bank sector, also in non-bank financial sector. Furthermore, the implementation of the ITRM is carried out in accordance with objective business policy, size, and business complexity of banking and non-bank financial institution. In addition, the implementation of ITRM is carried out in an integrated manner from planning to the elimination of IT resources. Policy, standard, and procedure for the use of IT at least include management, development and procurement, network communication, security information, disaster recovery plan, electronic banking services, service user provider, third party, provision of IT service by bank. On this regulation, banks are required to review and update policy, standard, and procedure on a regular basis. Banks are required to determine the period for reviewing and updating standard policy and procedure in written policy. Indonesia SA or OJK built a system to support subtech or supervisory technology. This system used as the automation of banking data processing to generate early warning signal through integrated data analytics. The signal is used to assist supervisor in detecting potential risks that may occur in the future, indication of governance in bank business activities, fraud, data manipulation, non-compliance with regulation, etc. The application of technology in conducting data analysis of banking, capital market, and non-bank financial institution data for the early warning system and compliance checkup in supervision, or we call subtech, will enable to supervise to do the following in a sectoral or integrated manner, such as real-time monitoring of key risk indicator and early warning signal, more factual early intervention on emerging risks, graphical picture view of firm behavior and practices, population-based, rather on data sample, and expert assessment of process and methodology. The use of subtech is only as a tool to produce a preliminary analysis, where the main analysis and the final decision still require the supervisor professional judgment. Due to COVID-19, as you know, the world is greatly dependent on technology. It has resulted in a rapid increase of money laundering cases and terrorist financing as well, such as business email compromise, which is now becoming a cyber issue in the financial sector. Business email compromise has a characteristic: first, fake email or website. There are slight variation to the legitimate address, thereby tricking victim into thinking the fake account is the real one. Second one, email spearsing. Emails that appear to be from trusted sender to trick victim into disclosing confidential information and use malware. Software can infiltrate corporate network and collect data harvest, including credential data, which is often used for the purpose of convincing employees to click on fake links or attachment containing files. BC has a scheme infiltration of victim information and email account. Criminals unlawful access victim email account, often through social engineering or computer intrusion techniques. Second one, sending transaction instruction. The criminal then use the stolen victim information to send fake email payment data transmission instruction to the financial institution in a manner that appears to have come from the victim. Make the third one, making an altered transaction. The perpetrators of the crime trick the victim, employee, or PGKs into the making money transfer that appear to be a legitimate transaction. That's one of the cases that come according to use technology. That's all from me, May. Thank you.
Thank you, Mr. Rinto, for sharing the Indonesian experience, although it came afterwards in our discussion. Thank you very much for highlighting these points and the learnings from the Indonesian experience. Lastly, I did not move to Ms. Sophie. If you have any other points that you want to add for our last question that we had on the specifications for Islamic banks and financial institutions.
Yeah, thank you, May. Thank you. I think a lot of things have been said, so I will try not to reiterate again what was said. I think from my perspective, again, I think what's important is to know yourself. I would say know your environment, assess your risks, so therefore your weaknesses, and don't go where you know you cannot go, right? I mean, we don't go, for example, here we don't go into the crypto. We don't trade finance. Of course, we do it for our clients. We do it for the clients that we know very well. We do it with the correspondent bank that we know as well very well, where we are 100% sure that everything is fine. Being in the gray list, we can't afford to be, you know, scrutinized even more than we are, if that can be. So I think for us, that would be my key takeaway. Adapt yourself, know your environment, work with the regulators. Of course, use the technology as much as you can when obviously they are good, and we've touched upon that. Some of them are very good, like OCR, like the Swift link tools that we do use internally as well, and obviously, yeah, work with all that and to better apply and the anti-money terrorism as well.
Thank you, Ms. Sophie, and thanks for sharing their good insights on this topic. So now we want to move to some questions that we have received from our audience. So one question says, measures such as responses to Wolfsburg questionnaire, correspondent bank due diligence are still manual in nature. So do these enablers need technology enhancement? So maybe Mr. Shawqi, you want to take this question?
Actually, as far as I know, usually correspondents and other banks send counterparty FIs two questionnaires which are designed by Wolfsburg. They are the CBTDQ, which is the correspondent bank due diligence questionnaire, and the FCCQ, which is the financial crime compliance questionnaire. So they are, I mean, the question is, you can fill them electronically, so, but sometimes you need to write like clarifications within. So what's the question, or what's the audience is trying to know about this? Can you reiterate, May, please?
Yeah. So the question was, do these enablers, like the questionnaires, they need technology enhancement to help even more? This was the question.
I don't know if I'm aware about the message behind the question, but let me seize the opportunity to talk about the challenges within this questionnaire from a personal point of view. You know, we as compliance officers meet the correspondent either on premises or through what we call the one-on-one interview, which is done remotely, sometimes via Zoom, or where you have your team talking to the compliance team at the correspondent end, and they try to know more about you, your measures, what systems you have, how do you do screening, how you deal with comprehensive sanctions targeting Iran, North Korea, how you deal with Russian sanctions, all this kind of stuff. But what I have learned is that sometimes they have also their own questionnaires. So you fill the Wolfsburg and their own, and they try to cross-check them, and you are really in a bad position when the data is not homogeneous across the two forms. And sometimes it happens like not with ill will, but with innocence, because sometimes you translate a Wolfsburg question from a different perspective than the correspondent questionnaire. And when you have this discrepancy between what you have answered on the Wolfsburg and what you have answered on the correspondent own questionnaire. This is a real problem. Another thing is that sometimes, in addition to the compliance team at the respondent end, there is also, for example, the RM or the customer onboarding. And here we need to be all on the same page. We need to be all aware of the compliance framework within the bank, because they look at you as one entity. So, and you know, sometimes a different department may interpret a policy in a different way because the culture is a bit weak. The training and the education and awareness has not reached on within the financial institution. So being on the same page on the respondent bank part is very vital when doing these kind of compliance interview and filling out these questionnaire requested by the correspondent.
Thank you, Mr. Shawqi. We have another question. It is a simple question, but one of our viewers want to understand more about the stages of money laundering. So maybe Ms. Sophie or Mr. Haider, if you want to just explain the 3 stages of money laundering.
I can go if it's okay. Yeah. So basically the 3 stages of money laundering are very simple. It's basically the placement, layering, and integration. What it means is placement is you hash from different activities, whether it be human trafficking, money laundering, drug trafficking, bribery and corruption, and then this has to enter into the financial system, whether through on the desk or on the counter deposit through financial institutions. And now we can go into details of criminals do use different, I would say, ways of depositing that cash or entering that cash into the financial system. And these can be, this reminds me of one, I would say, proposal being considered by a regulator in terms of lowering down the SAR thresholds, $200 to $250 even, you see, which is a very small amount, but they want to do it because on a collective basis that can, and if done in an intelligent manner, then can have a sizable impact in terms of dirty money entering into the system. The other is the second stage is layering. Layering is where you or criminals use different structures in terms of having various transactions that are carried out very in excessive or frequent manner, so that regulatory authorities or due diligence staff cannot keep a track of those multiple transactions, and it gets lost into details. And the third is integration, where you get this money out of the bank and put into different assets, whether from an equity perspective, real estate, and art and antiquities, or into gemstones and other things. And you just own those assets, which are quite valuable and at times very easily convertible into cash when required, and you are just selling your own legitimate asset. So these are the 3 stages of money laundering, and I hope that answers the question.
Yes, thank you, Mr. Haider. We have another question here, which is a very interesting question on the use of social media today, such as TikTok, for such money laundering and criminal activity. And the question says criminals have been using the application of TikTok to transfer money by providing support on live broadcasts to some parties with whom they agree. So in your opinion, what are some control measures that can be put in this regard?
Okay, so to be honest, I am not a user of TikTok myself, but my children do use that. So I'm not very much aware of TikTok, but I think what I can think of is if we have two things, basically. One is the underlying technology that is being used, or the transfer system that is being used, and how you control that. And from a financial institutions perspective or a fintech perspective, how we screen those transactions in real time and ensure that we understand who is the remitter and who is the beneficiary, and take the corrective measures in real time. I think that is one thing. And the other is documentation of all these stakeholders, and now fintech and these technology players entering into the financial system or the payment regime, I think the documentation of all these stakeholders is of paramount importance. I think these are the two ways perhaps which can work towards controlling any illicit activity or money being transferred which is not legitimate.
Yes, thank you, Mr. Haider. I want to end with a very interesting question on central bank digital currencies. So the question is, do you think central bank digital currencies are going to enhance anti-money laundering or further exacerbate the issue? And if so, how government should take, what measures should governments take actually to ensure that these central bank digital currencies, they do not become a tool for money laundering? So perhaps I can ask Sophie to elaborate more on this, and then we can move to the other speakers, if you would like to.
You said sanction? I don't
Central
think I
bank, central bank digital currency, CBDC, or if you want.
Is that like digital, like electronic money, or?
Yes, the central bank digital currencies. So I think we can, yeah, Mr. Shouki can elaborate on this, and then we can then back.
I guess the central bank digital currencies would be the good, legitimate way of a bit putting some kind of, or leashing back a little bit the aggressiveness of the crypto world. So when you have a back regulated currency, this will definitely lead many consumers within the financial community maybe to adopt or to go in the central bank digital currency and giving up maybe the crypto, which may be like high risk, high reward, but at the same time, high risk. So this kind of currency would stabilize a little bit the digital assets, because at the end, it has a regulator, it has an origin or an applicant or a someone who's holding this money within his or her wallet. And this will definitely have an impact on financial crime and decreasing to a certain extent the growing risk within the digital world that we have seen. And we have seen also lately, as I mentioned from the outset, how many virtual asset providers have been falling apart and being sanctioned due to laundering the proceeds through this digital platforms.
Yes, thank you, Mr. Shouki. So, Mr. Haider, do you want to add anything?
Thank you. No, I think a very valid point made by Mr. Shouki. I agree. These central bank digital currencies will support like bringing under control the bad actors and perhaps moving towards the effort of moving of the government or regional governments, for example, to move towards cashless economies. I think the physical exchange of cash perhaps can be decreased in a more controlled and more scientific and structured manner under these regulation or supervision of the central banks. I think that would definitely help regulators as well as central banks to control the use of physical cash and decrease the amount of illicit funds which are exchanging hands and are in circulation.
Thank you, Mr. Haider. Do you want to add anything? Or I think we have the time for another question. Another question is about the human capital. So, of course, the human capital can be an important source for money laundering within financial institutions. So how can we ensure that employees follow AML protocols and controls and they do not become a risk for money laundering within financial institutions? Perhaps.
Yeah, can I go?
Yes, okay.
Or it's Sophie's?
It's okay.
Sophie, please go.
You can start and I'll answer.
Okay.
Please.
You know, I'm a bit also keen on human capital and the human element. As you have the KYC, the KYCC, you can have also your KYE, know your employees, build a good, robust code of conduct, have internal ABC policies within the institution, have the tone set at the top for a good governance model, and whereby the upper management will lead by example and be a role model for other employees. Definitely, you may still have exceptions. You may still have people that can be lured by money or whatever. But once you have the systems, you have maybe also depending on the size and the complexity, you can have your own whistleblowing policy built from the inside for disclosing in good faith any violation or a wrongdoing. Also, disciplinary action may serve to achieve the objective of having an ethical and high conduct or high standard of code of conduct within a financial institution. All these factors should land you in an ecosystem where ethics are held to the highest standard and, of course, mitigate employee risk.
Thank you, Mr. Shawqi. Sophie, do you want to add anything?
Yeah, that was pretty exhaustive. And as I mentioned in my speech, initial speech when I was answering your questions, I think this is one of the biggest challenges. It's always been, it's not new, that's for sure. But I would insist on the voice from the top. There needs to be a management that shows that is involved, that the management is aware, the management is very sensitive to this. I always ask my management to, whenever they do a speech about anything, performance or anything, to have one word, just one word about fighting money laundering, because that shows their implication into this fight. Because as Shawqi was saying, you need to have a comprehensive model with disciplinary, with the training, proximity. But for me, the voice from the top is very important.
Thank you, Ms. Sophie. And I think with this, we will finalize our webinar because we don't have much time. So in 1 minute, I want to ask each speaker to just give us a key takeaway for financial institutions to consider when it comes to AML, and then we will wind up our webinar. So I will start with Mr. Haider, and then we can go to Sophie and Mr. Shawqi.
Yeah, thank you, May. I think my key point would be embrace technology, and embrace technology with the right mindset where you have, and I would say at the deep, like within your heart or within the nucleus of the organization, you have the only sole purpose of that adoption is to have greater controls as well as the right infrastructure to enable financial inclusion. I think these are the 2 points I would like to make from a technological perspective.
Thank you, Mr. Haider. So Mr. Shawqi, last word.
Yeah, the big takeaway is that I had a wonderful time discussing with fellow panelists. But for the webinar, I would say that compliance should not be regarded as a cost center. It's a revenue guardian on the long run. And do not let the number of employees drive the number of your treated alerts. Let the alerts drive the number of the employees you need to run a compliance framework or program.
Thank you, Mr. Shawqi. Ms. Sophie, last word.
Yes, sure. As I said, I think it's, for me, the takeaways is know your environment, know where you are, know where you could be used for as a money launderer, which you don't want to be. So be aware and adapt your framework to where you stand in the financial market.
Thank you, Ms. Sophie. And Mr. Rinto, if you can share with us your takeaways of this webinar.
From my side, I would like to, from supervisor side, I think according to technology development, we need to risk mitigation. First of all, we need to strengthening the policy, also strategic strengthening institutional, and then research and development, and then also strengthening the regulatory framework, strengthening the licensing process for reporting parties, also law enforcement. This is the most important. And then human resource capacity, coordination and cooperation between multilateral, local, regional, and global. And the last, strengthening of information utilization. That's all. Thank you.
Thank you very much, Mr. Rinto, and thank you very much for all the speakers that have joined us today for the insights that you really shared on and the fruitful discussions that were covered on the topic of this webinar. So ladies and gentlemen, we now come to the end of our webinar. We would like to thank the audience and participants for their attention and for the active participation. And please visit CIBAFI website and follow us on social media to be updated on CIBAFI's activities and initiatives. We thank you again, and we look forward to seeing you in our future CIBAFI initiatives and events. Thank you. Have a very good day ahead. And
Thank you, everyone.